Welcome to The Explainer. Today, we're going to tackle something on your pay stub that might have you scratching your head. That taxable benefit for your employer-paid life insurance. I know, it sounds super complicated, but trust me, we're going to break it all down.
So let's just jump right into the big question, the one that probably brought you here. If your employer is paying for this insurance, why on earth is it showing up on your pay stub? Is this free perk really free? Let's find out.
Well, the whole reason comes down to this idea of a taxable benefit. Basically, the Canada Revenue Agency looks at certain non-cash perks, like an insurance policy your company pays for, and says, hey, that's a form of income. And just like your salary, income gets taxed.
Now for the good news. You absolutely do not need to be a math genius to figure this out. To get the exact taxable amount, you really only need 3 key numbers, and you can usually find them right in your employee benefits package.
Okay, first up, your annual salary. Simple enough, right? This is kind of the foundation for the whole calculation.
Second, you'll need what's called your coverage multiplier. Your benefits plan will spell this out. It just tells you if your life insurance is worth 1, 2, or maybe even 3 times your annual salary.
And the third piece of the puzzle is the premium rate. This is just the price your employer pays the insurance company. It's usually a pretty small dollar amount for every $1,000 of coverage they buy for you each month.
Okay, got those 3 numbers? Perfect. Let's put them to work. We're going to walk through the calculation step by step so it's all crystal clear.
And to make this super real, let's use an example. Everyone, meet Rhonda. As you can see, we've got all her info lined up. Her salary, her 2 times coverage multiplier, the premium rate, and the fact that she gets paid every week.
And you know what? The whole thing really just boils down to 3 straightforward steps. Seriously, that's it. Let's tackle them one by one.
All right, step 1, we need to figure out the total value of the life insurance policy. It's super simple. Just take your annual salary and multiply it by that coverage multiplier we talked about.
So for Rhonda, we take her $30,300 salary. We multiply it by 2, and that gives her a total life insurance coverage of $60,600.
But wait, here's a little quirk in the rules, but it's really important to get this right. The total coverage amount always has to be rounded up to the next $1,000 mark. It's a small detail, but it's absolutely crucial.
So, even though the math gave us $60,600, for tax purposes, we have to bump that up. Her official coverage for our calculation becomes $61,000.
Now that we've got our rounded up number, we're ready for step 2, figuring out the monthly value of the benefit. All we do is take that total coverage, divide it by 1,000, and then multiply that by the premium rate.
So for Rhonda, that's $61,000 divided by 1,000, which is 61. We multiply that by her $1 premium rate, and boom, $61 per month. That's her monthly taxable benefit.
But hold on, you're probably not paid monthly, right? You get taxed every single payday. So, for our final step, we have to convert that monthly benefit to match up with your pay schedule.
Rhonda gets paid every week, so we take her $61 monthly benefit, multiply it by 12 months, then divide the whole thing by 52 weeks in a year. And there it is, $14.08. That's the amount that gets added to her taxable income on every single paycheck.
Okay, so you've got the calculation down. But what happens if we start playing with the numbers? Let's take a look at how changing just one of those variables, the coverage multiplier, can really impact your bottom line.
And this chart just lays it all out so perfectly. Take a look. If Rhonda's coverage was just 1 time her salary, her weekly taxable benefit is about $7. At 2 times, it's that $14 we just figured out. And if she bumps it up to 3 times, it jumps all the way to $21. The takeaway here is pretty simple, right? The more coverage you get, the higher that taxable benefit is going to be.
All right, we're almost at the finish line, but there's one last little wrinkle we need to talk about, and this one depends entirely on where you live. Not every province handles this the exact same way.
See, in most Canada, the calculation we just did is the whole story. But if you live in Manitoba, Ontario, or Quebec, things are a little different. These provinces tack on a provincial sales tax to the insurance premiums themselves. And guess what? That tax gets passed along and included in your taxable benefit. Let's look at Quebec, for instance, with its 9% tax. If Rhonda worked there, her $61 monthly benefit would get hit with that 9%, bringing it to $66.49. Her weekly benefit would then jump to over $15, a pretty noticeable difference from the $14.08 we saw before.
So what's the bottom line in all of this? It's exactly what this quote says. Even though your employer is footing the bill, the government sees the value of that coverage as income and you're going to get taxed on it. But
And this is a big but. It's almost always a fantastic deal compared to buying a policy on your own. So no, it's not totally free, but it's still an incredibly valuable benefit.
And there you have it. You are now equipped to decode this very common and often very confusing part of your compensation. Which really just leaves us with one final thought for you. What's the next mystery line item on your pay stub you want us to tackle?